Josh Puletti, and we are in studio with Churchill, Texas.
My name is Ryan Bernal, and today we have the luxury of one of our fellow loan officers here, Darren Edgar, joining us. And Darren, it's a pleasure. Happy to have you. Before we get too far, I don't want to just jump in and start going on all sorts of topics. So please introduce yourself. Tell us a little bit more about who you are, how you became a loan officer, and what you love, why you love what you do.
Yeah, so my name is Darren Edgar. I've been in the industry for over 20 years. I think 22 years. Anyway, I've been in the industry in a lot of capacities. I started out as an account executive, and then I went to a processor, made it up to an underwriter, and then eventually back to a loan officer, which is obviously dealing more with the borrower face-to-face, which I find more appealing and a little more exciting and just better overall for me.
Well, and let's speak to that a little bit because, coming from the more technical side and moving to something that's much more people facing, what shifted that? What kind of caused that motivation to move more in that capacity?
Yeah. So I went through the 2008 crash, right? The real estate crash that had a lot to do with it. Right. Just dug deeper into, the behind the scenes of of why we do what we do. I've always kind of been a technical person, wanted to know the why behind everything, and as opposed to just doing it. And then became interested in the nuances of loans, like, why do some people get a loan? Why do some loans go bad? Why are some loans safer? Why does everybody get different interest rates? Like all those things that you probably wonder about, but it's just really technical. And then just dove in and took about 2 or 3 years to kind of learn all those guidelines and become what I consider a great underwriter. Most underwriters have this, facade or this characterization of trying to turn down loans, right? Like you feel like they're against you. Well, I tried to do the opposite. I look at a loan file and I say, how can I make this work, right? Why should I do this loan? Right. And it's a different way of looking at it. And there are underwriters that do that. But I feel like that helps me in my current capacity because I go into a loan with that mindset, but also knowing the guidelines. I know what the underwriter is looking for before I turn it in. So I make sure that everything's laid out and all their concerns are addressed up front. And maybe there's something negative about, a borrower or a client. What you don't want to do is try to hide that. What you want to do is bring that to the surface, discuss it, and be upfront about it, and figure out a way to make it work up front. Your chances of getting the loan done with that approach, as opposed to trying to hide it, is much more successful.
Well, and we had talked a little bit off camera too before we really jumped in here, kind of about, your passion in doing these loans. And one thing I found to be very, very interesting is more of like the counseling and educational piece, because like you kind of mentioned, it's important to bring some of those things to the forefront. And so speak a little bit to that and how you truly try to counsel people, because I think that's probably the most interesting part of being a loan officer that either some folks are going to pour really far into, or they'll do kind of as you said, and they'll hide things and they'll try to just get by.
Right. In all positions, there's different personalities, and in the loan officer position, there's kind of two camps, right? There's like, let's just let them borrow as much as they possibly can because we get paid more if they borrow more, right? Or realtors the same way. Here's how much house you can buy. Don't you want this house? Well, just because you can doesn't mean it's a great idea, right? The mindset that's gotten a lot of people in trouble, and I've known a lot of people, including myself, that have gotten personally in financial trouble, is because we thought we deserved something because we could get it. Right. And that's kind of the mentality that's gotten a lot of people in trouble, as opposed to planning for times up ahead, make sure we live within our means and all that stuff. So I started, had about 10 years ago, started teaching Dave Ramsey's course on financial stewardship, and just saw how it changed my life, how it changed other people's lives who I saw that were applying these principles, living within our means, living conservatively, saving up, being prepared for emergencies.
Right.
Just the the peace. I mean, it's called financial peace for a reason that you have. You just don't have those daily stresses about finances that most people have because you proactively plan for stuff, right? And so buying a house is going to be the biggest investment most people make.
Oh, yeah.
Right? So you do not want to set people up for failure. Now, unfortunately, they will let you buy more house than you should buy, right? And that's not a good thing. So I help. I look holistically at each client's financials from A to Z, and take the whole thing in as a picture and say, this is what you should be doing. Now, this is what you can do. I always show them what you can do,
right,
and I show them why it's a bad idea to do that. And here's what you should do. Now, sometimes the should do is you're not ready to buy a house, right? And I'm okay having that conversation with them. I can sleep at night because I know them not helping somebody make a bad decision that I know very well could be a financial ruin for them in the next couple of years. Right?
Absolutely. Oh, I mean, that's one thing that I find to be very, very fascinating is, I feel like here at Churchill, most of the loan officers I've talked to, they advise just a little bit differently. And it really takes into account, how the people we work with are living their lives and whatnot. And so I'd like to spin back a little bit to the financial piece and kind of teaching Dave Ramsey. How long have you been doing that?
About 10 years.
Wow.
I've been doing that 10 years. I do one in the fall and one in the spring. And me and my wife together will do a table of couples. So kind of, we share our story and how we got to where we are, and we help teach the course to about 8 couples that are at our table.
Well, and one thing is too that, I kind of wanted to, I guess, hear more about is that conversation, because a lot of the times we do have to focus on that conversation of maybe not now, right? And that's always a really, really hard conversation to have, especially when you tell someone they aren't qualified.
Right.
And so, how do you kind of lean into that? And, how do you make them realize, because I think that's really tough for some home buyers, is hearing, yes, we can qualify for this, but we should be weighing this a little bit heavier in our budget and how this affects our lives. So kind of how do you attack that, and how do you, I guess, make sense of it to a borrower or to someone we're working with?
Yeah, no, that's a great question. Look, you can buy this house, right? I've had people who move forward even after I told them this is probably not the best time for you to buy a house. A lot of those will be, I've seen people spend down to their last $100 they have to get into a house, which is, it's crazy to me that that's actually possible to do. Why would you give somebody a loan that has $100 left in the bank once they move into the house? That just doesn't seem right, but you can do it, right? I've had people do it. And of course, I'd rather me help them,
right,
and counsel them. And if I say, look, if you want to do it, I'll help you. I don't want you to go anywhere else. But I highly advise against it. What I advise you do is let's get some money set aside so you have a cushion. You're going to move into this house, and within the first couple of months, something's going to go wrong. And you're going to have to reach for a credit card and move further into debt. And it's just going to be a slippery slope that you don't want to go down.
Well, I'll tell you what, too. Yeah, buying a house and leaving yourself $100, you're barely replacing the air filters in the house for that. You know what I mean?
Yeah. It's crazy.
You can't do that.
You're
and
not
so
going to be able to fill up the refrigerator.
Oh,
right?
No, absolutely
right.
not.
So I have that conversation with them and kind of just let them know that, hey, this is what you're getting yourself into. And I'm a big fan of, hey, let me just show you the math. Let me show you what your monthly budget looks like doing this, because we're qualifying people off pre-tax income. Well, that doesn't really matter to them. How much is hitting the bank? How much is going towards your mortgage? How much is estimated to be going to your utilities? And let's see what sliver you have left for vacations, going out to eat, saving for retirement. Sometimes it's close to zero. And I just show them those numbers. And, if they don't listen at that point, well, that's completely on them.
Well, and doing this long enough too, you kind of see the folks who are willing to take that kind of education, the folks who are not. And so kind of let's rewind a little bit to, how you said you and your wife got into the Dave Ramsey teaching the financial piece. Share a little bit about that story, because I think the most daunting thing sometimes for folks is change. And ultimately it's changing your attitude, changing your mindset to how you go about living your life financially. And so, what sparked that change, and how can you, almost influence others to kind of follow in that path of like, you will be better off. You just have to trust and kind of pull the trigger now. So
yeah.
How did y'all get into that?
Yeah, so how we got into it is we became engaged, and at that time I was like every other single, where I was just kind of winging my finances, but I was only, I only had myself to account for, right? Now I was gonna have to account for someone else, and then possibly some children in the near future, and I was like, man, I don't really know much about finances, and I probably should, right? So I was always been a big talk radio guy because I was a salesperson that was in a car most of the time, and you get sick of listening to music after a while. And I came across Dave Ramsey and just started listening to him. At first, when I first heard him, I'm like, this guy has something to sell. I'm like, what's the big deal? I thought he was like in Tony Robbins or something. I had no idea, but I thought he was just maybe selling CDs or something.
Right.
And then I found out this guy's actually doing it because he really cares. And not only does he care, he's basing this off biblical principles, right? And I was like, man, this is the real deal. So I'm just going to start following it. That's it. I just decided I was going to do it, and whatever it took, that's what I was going to do. And within a year, we were debt free. We paid off $88,000 in 11 months. Basically, my entire paycheck was going to pay off debt while we lived off her paycheck. And we decided that when we get married, we're going to have no debt from the very start, and we made it happen. So we actually went to Dave's office and did the debt-free scream over the radio and did the whole 9 yards. But yeah, and ever since then, it changed our lives. I mean, we just noticed that we have families around us, and they just have all these financial difficulties. Married people that go to church that are great people, right? Good health, they have great jobs, everything. They still have financial stresses in their marriage, and we have none of that. We have our 15-minute meeting once a month. How are we going to budget for this month? I sign off on it, she signs off on it, we execute, we're done. There's absolutely no problems at all.
Has it always taken 15 minutes to do that meeting?
No, it doesn't. The first 90 days is the roughest.
Right.
You're going to kind of figure out how everything works. But after about 90 days, I mean, you kind of figure out what your life looks like and what's needed, and we're prepared. My air conditioner went out last week. It was $3,900 to get the thing fixed. It was not a sweat at all because we had a home emergency.
Just a plan in place.
A plan, and we just pulled from that account, and now we're going to replenish that slowly so it's back up to where it needs to be. But there was no, how are we going to pay for this? Where is it coming from? We knew. I mean, there was absolutely not even a conversation about it.
Now, did you guys do the full envelope system with actual physical envelopes?
We did. We did the envelope system when we first started. After a while, we came to virtual envelopes, which is on a spreadsheet. Now, we're a little more technical and detail-oriented than most people are, we found. But I highly recommend when people get started doing the envelope system. And then once you get used to how much you're spending, you can probably wean yourself off the envelope system. But that's kind of the fail-safe, right? If it's not in the envelope, you don't spend it.
Right.
Yeah. So, but yeah, we started teaching that course, and I think to answer your question is, who are the people that bite and take this seriously, and who are the people that don't?
Yeah.
I wish I could say everybody did. I mean, people have enough initiation to sign up for the course, to say, I need help, or yes, I want to learn. But I think what it comes down to, unfortunately, is the people who don't have enough pain don't change.
Right.
When people come in, I say, hey, what is your status? Are you in crisis, or are you kind of, pre-crisis, or are you doing well? And almost 100% the people who say they're doing well almost never change, right? They say, well, the way I'm doing it's fine. Mm-hmm. Well, it doesn't mean it couldn't be better. It doesn't mean something bad's not going to happen next year that it's going to sink you, right? So, what Dave says is people only change when the change of staying the same exceeds the pain of change. Mm-hmm. Okay? So they have no other choice, in other words. Right. And that's unfortunately what I found. In those people, it's great because they're serious. Right. They're sick, and he says they're sick and tired of being sick and tired. And when people come in and they're crying and they're mad, I'm like, okay, I'm concentrating on you because I know you're going to do this. right? It's funny the way that human nature is.
Oh yeah,
Right.
well, and that's the thing too, because it's like I feel like with humans most of the time, it's you have to see it to believe it, right? You have to have that first aha moment, that first you get caught out with a flat tire, and you do have an emergency fund, and I think that first bubble clicks, and you're like, wow, this makes sense.
Yeah.
And so, what was that aha moment for like you and your wife? You know, that first hardship where it came up, and you were like, you know what, we're actually not worried about this whatsoever.
Yeah, I mean, so I like to think I didn't feel the pain before
Mhm.
I changed. I'm kind of an exception to that rule because more what changed me is I got nervous about having a family,
Right. Well, that's a whole
Okay.
different pain,
Yeah.
right? You know.
right? I'm like, I want to be prepared. I don't know what that looks like right now, but one thing I don't want to do is when I know people are relying on me, especially family, I want to make sure I'm not messing up. Right. So I kind of just had the forethought of like, I need to get my financial house in order before I start having kids under
Yeah.
my roof and I have a wife and everybody else that's depending on me. So I'm kind of an exception to that rule. I think what happens to most people is they probably aren't that proactive and then they get married and they start buying stuff and then they're just like their marriage starts falling apart because they're like, you spent what on a purse and what's going on and we don't have money for that. And then they come to financial peace.
Yeah.
I think that's probably 99% of the people that do it. That wasn't my story because I was trying to avoid that happening.
Right.
I was older when I got married. I like to think, I'd seen enough other people have bad marriages, and I kind of wanted to avoid all the pitfalls.
Amen.
And if you don't know, finances is the reason for more than 50% of the divorces in America. So if you're gonna have a good marriage, get your financial house in order, and you probably have a good marriage more than likely.
Amen. I can't
Yeah.
disagree with that whatsoever.
Yeah.
Granted, I'm not married, so everyone out there, I can't. But listen to Darren; he's making a lot of sense.
It is available though.
Yeah. The buying a purse from we don't have money for rings a little true every time you get that Amazon notification and it's like, oh, I didn't order that. Interesting. Don't know we need that. Okay. Yeah.
Yeah.
Apparently we need to do financial peace.
Well, and let's pivot a little bit to first-time home buyers, because
Okay.
I think right now, especially over the last 2 years, it's been tough for first-time home buyers to really hop into things unless you really have a lot of reserves, a lot of money sitting aside. But coaching, what is the biggest piece of advice you do give to first-time home buyers? Is it the patience of everything? Is it watching every dollar per se? Is it where do you find yourself lending the most useful advice to people who are really just trying to buy their first home?
Yeah. When I talk to somebody that's a first-time home buyer, I let them know that, hey, the right time to buy a home is when you're prepared to buy a home. A lot of people will call and say, the rate's too high, or I need to do this, I want to do that. And, I say, wait, let's find out where are you truly at, right? So I get all their information, the story from A to Z, which is basically an application, right? And once I have that application, I've had people call and they say, we're not ready.
Mm-hmm.
And then I dig a little deeper and I'm like, you're completely ready. And I've had people that say, oh, we're ready to buy a house. And then you take the application, you're like, you're nowhere near ready, right? So you can't take what people say that have never bought a home who think they're ready or they're not ready.
Right.
So get all the information and then help them determine whether they truly are ready, right? So that's typically what I do is, gathering the information as accurately and as thoroughly as possible is really what a loan officer does. I mean, that's the nuts and bolts of it.
Now, on that first-time home buyer piece, talk about down payments and how much someone needs to bring to the table if they're buying their first house.
Yeah. So if you're a first-time home buyer, I mean, really the biggest benefit of being a first-time home buyer over somebody who's not a first-time home buyer is on a conventional loan, you have the ability to put as little as 3% down, okay, instead of 5%. That's not really that big of a benefit. I think out there in marketing, the term first-time home buyer is thrown around a lot. Like, hey, if you're a first-time home buyer, you get all these benefits. I think that's kind of not true, right? I mean, what I just mentioned is really the biggest benefit. You can put down at less 2% than anybody else, right? So, I mean, when you think about it, it'd be kind of silly to have first-time home buyers have more benefit because who's more risky than a first-time home buyer?
Right.
Yeah.
If anything, they have less benefits. But anyway, that's beside the point. But yeah, so I just tell them right off the bat, hey, just because you're a first-time home buyer, really, that's really the biggest benefit. Yeah. I mean, besides that, there's not a whole lot. There are down payment assistance things programs, I should say, that are good for first-time home buyers. And we definitely take advantage of those with people who have the right fit for those. I will say on down payment assistance programs, again, like anything else, just because you qualify for it doesn't mean it's the right thing for you to do.
Mm-hmm.
There are people that, hey, this is the best thing for them because, and I was having a conversation with a loan officer yesterday about this, when should I tell people about this down payment assistance? I was like, well, if they have their own money saved up for a house, then obviously they don't need it. There's a lot of people who they have the 10%, the 20%, but they're like, well, what about down payment assistance? That's for people who don't have the money that you have, right? It's always better to use your own money to buy a house because down payment assistance programs come with strings attached in the form of a higher interest rate, right? You're paying back that money slowly over time in the form of a higher interest rate. There really is no free lunch. You're not getting any free money.
And I loved when you said that earlier too about the marketing of first-time home buyers. I think I see that a lot where I'm talking with someone and they've had a conversation elsewhere prior to coming to Churchill, and they tell me about this great program. They tell me about this great program where they're getting, $10,000 towards their loan, and they're only going to take a 7% rate.
Mm-hmm.
And we get through the information, as you mentioned, and they've got $20,000 sitting in the bank, maybe more in retirement, things like that. It almost feels predatory, like almost in a way of like it, because it makes it seem so beneficial. But like you said, there's a lot there that if you really prepared to buy a home, the correct way, did the right thing, saving, you don't need to look at these programs. But let's pivot to the folks that may need to look at those programs. So explain to us kind of what down payment assistance is, where it comes from, and a situation where you would maybe in fact recommend that.
And do you need to be a first-time home buyer to use down payment assistance?
Right. So now they're all different. There's thousands of down payment assistance programs. Some come from city, some come from the county, some come from the state, and some are nonprofits, right? One that we do here is a nonprofit. And so you do not have to be a first-time home buyer all the time. Now, for some of these you do, and they're all different. You have to read the fine print on each of these down payment assistance programs to determine, whether you have to be a first-time home buyer. Now, the one we have, you do not have to be a first-time home buyer. I'm actually helping someone now who has 2 investment properties. He's closing tomorrow, and he's buying his first principal residence, right? So you actually do not have to be a first-time home buyer for that. So anyway, the people that I think are good candidates for this. What I always say is, if you get this has happened a couple of times where I'm just like, I used to think, I'm never using this down payment assistance,
right?
Because if you need that, then you're not prepared to buy a home. That was kind of the first thought. But then I've come across a couple of clients, like maybe single moms. They have 3 kids. They're in an apartment. They're in what maybe is a dangerous situation. Like a risky neighborhood.
Oh yeah.
For lack of a better word. And, she has $5,000 saved up, but it's going to take her another year or 2 to get the extra 10 needed, right? Or maybe 6 needed. Like they're going to have to stay there for that. I mean, anything's better than that, right?
Oh, yeah.
So I think the down payment assistance is great for them. That's just too long for them to be able to get into a home, to get out of a situation that's pretty dire. Right. So if I can help, I've helped a couple of families that come to mind that were in that situation where I think, yes, they're going to have a higher interest rate than normal, but it's better than renting and it's better than where they're currently living. And I can get them into a house with a backyard where the kids can play in a safer neighborhood. I'm going to do it.
Right.
So, I mean, that's really the best situation I've seen for down payment assistance.
Right.
Even if they weren't in a bad situation, if it was anybody who, for them to save up enough money to get into a house is just too far out, then a higher interest rate is better than renting.
No, wait.
Renting, what is your interest rate? 100%.
100%.
Right? It might as well all be interest.
Right.
Right. So anything's better than renting, arguably.
Well, and I think that's one problem right now that most folks I talk to daily, they see where interest rates are, and historically they're not even that bad. 5.5, 6, somewhere in there, low 5s, and even now some points. Tell us a little bit about that rent versus own, because That's the thing that I think, when I talk to someone, I tell them about property taxes here in Texas, how they're, going to be higher and they're going to take a little bit of higher interest rate. And buying a house results in a $2,200 payment versus paying $1,800, $1,900 for rent. Why do you still come out ahead owning a home rather than renting?
All right. There's two ways that you come out ahead. One is each time you make a payment, you're paying some principal, you're gaining ownership of the home, of the real estate. Right.
Mm-hmm.
So, and also in an ideal situation, that home is also appreciating over time. So you're gaining equity in that way. With rent, you really aren't gaining anything, not a penny either way. Right. You just have someplace to lay your head for the next 30 days. That's really it. Right. You get that with a house, obviously, as well. So it more than pays for itself over time. Now, the only reason not to do that is because the payment's a burden, right?
Right.
I mean, that's where most people make their mistakes. Owning is always better than renting. Now, there are people who, like, they're in a certain stage of life where renting is the best option.
Right.
You're somewhere temporarily. You don't know how long you're going to be there. That type of thing. But if you know that you're going to stay in this city, like, hey, I got a job here and this is where I'm planting roots. To not buy when you have the money saved and rent instead is a poor decision, in my opinion.
And, there are some other things associated, with owning too. You're going to get some tax breaks, other things that make it even more, how would you say, feasible. Can you give us a little bit of insight into that? What as a homeowner can you do, come tax time to, kind of reap even more of a benefit? Well,
you can deduct the interest from your taxes. Right, you can you get a 1098, I believe, as the form at the end. It shows all of the interest you paid that year towards your mortgage. You can write that off. Now, while we're on that, so I've had a lot of people in the Dave Ramsey course. They'll say, "I don't want to pay my house off because then I won't get that interest." Okay, let's look at the entire formula there. I'm going to continue to pay interest so I can write this off. It doesn't come out ahead if you look at the entire situation, no. But it's always hilarious how people think that way. You have to look at the broad spectrum there.
Well, speaking of taxes, coming from an underwriter's background, if you were talking to a self-employed borrower who was approaching tax season and they were planning on buying a house a year or two down the road, what would you tell that person to be cautious of as they prepare to buy a house when they're filing their taxes?
Yeah, that's a good question. Okay, so as soon as I know I'm talking to a self-employed person on the phone, you have to just kind of stop there and say, okay, how long have you been self-employed? What do you do? And just let them know, here's how your qualifying income is going to be determined. It's going to be averaged out over the past 2 years of tax returns that we receive. Okay, so we can only use what's analyzed from the past 2 years tax returns and take a monthly average of that. Okay, so, and a lot of self-employed people do creative accounting. So they may make plenty of money, but on paper, using their tax returns, it looks like they make very little money.
Right.
That's not going to be a good formula for getting qualifying income for a mortgage, right? And so I let them know that. I mean, that's about all. That's basically all I say. Like we have to use what's on the taxes, whether it's truly what you get paid or it's not what you get paid. Now, there are other programs that are around, like bank statement programs that you can use. Now, those come and go, and they're kind of new and they're not super solid programs. I don't like to use them if I don't have to, but those are available for people who do, quote, creative accounting on their taxes for self-employed people. But I highly advise them against that because that comes with a much higher interest rate. It'd be much better to go conventional, get a better interest rate using your tax returns. So when I'm talking to a self-employed borrower, if they have their past 2 years tax returns available, I'm like, hey, let's stop where we are, send those to me before we go any further. Let's see how much qualifying income we can use before we, I get your hopes up on anything, because you never know what those are going to say.
Oh, yeah. And that's the hardest thing to explain too. Like, you really hop into someone's tax returns and you're like, hey, this is what we can qualify. And they're like, What do you mean?
Well, I'll actually just show them the calculation.
Yeah.
Right. I'll send them it's a worksheet. I plug in numbers from there into this worksheet and it spits out a number, and that's what I'm allowed to use, which is basically, you can add in some different things, and it's super technical to me at least, but I just put it in the worksheet and the worksheet spits out a number. I'm like, this is what we can use for your monthly income. Now, another thing is we have to use 2 years most of the time. There are a few instances where you can use 1 year, but we have to use 2 years most of the time. And if, say, 2020 was a great year and 2021 was maybe he did 75% of what he did the year before, we can't use any income. That's too much of a decline, so zero. So can't help him at all.
Man.
What is that instance where you only have to use 1 year? Didn't that change during COVID? Is that still...
I don't know if it has something to do with COVID. I think it was before. It's typically with Freddie Mac, which is an agency that if they have record of him being in business for more than 5 years, then you can use 1 year, but not all the time. So when you take a loan application, here's one thing I try to tell people, and a lot of loan officers don't even know this. They look at things in compartments, like, okay, these tax returns, what's required? Well, sometimes 1 year is required, but why is 1 year required? Because this guy has a great credit score, he has tons of money in the bank, and he's putting down 30%. Like, it's weighing risk across the entire spectrum of the application to determine how stringent it's going to be on a lot of things. This guy has a crummy credit score, he's spending every dime to go in there, I can guarantee it's going to need 2 years of tax returns.
Yeah.
So that's kind of how that works. That's also why sometimes you get an appraisal waiver, right? It's not always based off whether it has information on that house in its value. It's also looking at the credit score and everything else, and you can get an appraisal waiver if you have a better, if someone's buying the same house, someone has an 800 score and someone has a 620, you're probably not getting the appraisal waiver on the 620, even though they know the value of the house just as certain, right? But overall, it's all based off who has the chance of foreclosing more.
Yep.
Right? That's really all we're determining. Because if we knew everybody was going to pay all the time, then everybody would have the same interest rate. Because an interest rate is a measure of risk. That's all it is. We get more money to the riskier. We make more money off the riskier people.
And that actually sparked two questions in my brain that I feel like I just want a little more information on as a listener. I think it'd be extremely helpful. First, appraisal waiver. What is that? In this process, if someone receives an appraisal waiver, because it's different on the offer real estate, realtor side than what we talk about when we talk about an appraisal waiver.
That's right.
So explain a little bit of that and how that affects someone in their loan. And then second question, which you can choose to tackle these, whichever way you see fit. But the second question revolves around, dang it, I forgot the second question.
That's okay.
Get appraisal waiver. I'll remember
the appraisal waiver one. So it can be quite confusing. I was confused when it first started happening too. For the real estate side, the realtor side, making an offer on a house, you can have what's called an appraisal waiver, saying, I want this house so much, right? This $400,000 house that I'm going to give you an extra form or addendum that's an appraisal waiver on the contract saying, I don't care what the appraisal comes in at, I'm going to buy your house anyway. Right. So this $400,000 house, if the appraisal comes back at $350,000, I'm going to go ahead and just bridge the gap between the $350,000 and bring an extra $50,000 to close. I guarantee that, and I'm putting it in the contract. That's nuts in my opinion, but people are doing it. Okay. And appraisal waiver, as far as the financing goes, means that, hey, to qualify for this house, we're not going to require an appraisal. Now, typically what this is based off of is I'm going to feed your application and your credit into a software program. It's going to tell me, one, did you qualify for the loan? And if so, what do we need from you? Pay stubs, bank statements, tax returns, whatever. And also, is an appraisal required? Now, to determine whether an appraisal is required, we already talked about it's based off the risk of the borrower, right? And it's also based off, how much information do they have in the database of that home maybe that home specifically, or homes in the neighborhood around it that have sold recently that can substantiate that purchase price.
Mm-hmm.
If they have enough data that shows, hey, this house is easily worth market value of 400, then appraisal waiver. We don't need an appraisal.
Right.
They've already substantiated it using information they have saved in their database, right? And they feel like this guy's a good credit risk, so hey, we're not even going to bother him with an appraisal.
Right.
Right. So
wow,
that's how that works.
That's very convenient. And I remembered the other question I had, and it's about the term layered risk. Because, what I always explain to folks is there's a lot of levers in loans, and you can have different things happen that affect approval status. So talk a little bit about the layers and kind of what layered risk really translates to when evaluating a potential home buyer.
Yeah. So the way I've explained it to people on the phone, and I think it's a good way for them to visualize it, is I think of a tripod. Okay, you got 3 legs. And if one of those legs is missing or breaks, the whole thing falls down and you don't get the loan. And those 3 legs are credit, income and employment, and assets or money you have in the bank. Right? And so you have to meet each one of those independent of each other. They're completely independent of each other. And if you're missing one or you fail on one of them, you don't get the loan. Okay, so that's kind of like the tripod of a loan. Now, layered risk. What layered risk would be is you have factors in your situation that are, we always know there's some risk, right? The biggest risk on any loan is that, in my opinion, like, what's the number one thing that can happen to somebody that caused them to miss a payment? Like, most likely
losing their job.
Lose a job. Everybody knows that one. It's actually pretty prevalent. So that's what most of it's based on. That's most risk for most people. Even someone with great credit, the more likely thing that could happen to let them miss a payment is a job loss. More than likely. And that could be medical. It could be a lot of things. But job loss is the most
detrimental. Yeah.
Right. Most realistic thing to happen. Layered risk would be like, okay, you can make exceptions to different things, right? You could say, okay, well, we're going to make exception to this, but you always have to have what's called a compensating factor, right? Like maybe your debt ratio is high, right? The amount that your home payment is, and compared to your income, is fairly high. Right. So say you make $5,000 a month, but your house payments can be $2,000 a month. That's pretty high.
Yep. Right.
For a house payment. But you have $500,000 in the bank. That's a compensating factor. That weighs that out. Okay.
Gotcha.
Layered risk would be where you have a high debt to income ratio, but you have very little in the bank, little reserves, it's called, and you have a low credit score.
Yep.
Like, that's too many risk factors. They're laying on top of each other and there's nothing to compensate for it. Right. So remember the tripod, like, they all have to stand. Right. But if you have a weak, say, credit score, it helps if this leg over here has a lot more money in the bank.
Yeah.
Or this leg over here, you could have a terrible credit score, but your mortgage payment's 10% of your take-home income, so you have a low debt to income ratio. That would be another compensating factor, right? So that's how that works. I mean, so if one of the credit, income, or assets are weak, it can be made up for by one of the other ones being exceptionally strong. When they're all weak, that's layered risk and not good for the most part.
So who decides that layered risk in compensating factors? Is that just a person, underwriter, that makes that decision? I always used to joke that underwriters are the trolls that guard the bridge. So I kind of want to pull the screen back. Is that a person? Is that all based on guidelines? How does that work?
Yeah. So most of the time, it's not up to the underwriter. It's not up to us. It's up to Fannie Mae, Freddie Mac, and their software program. Our job is to take the application as accurate as possible that reflects reality, right? Get those numbers as good as possible, combine that with the credit report, feed it into the software program. That software program is looking at risk across the board, and it gives us a thumbs up or a thumbs down. If it gives us a thumbs up, as long as we can prove that the numbers that we put on that form are accurate, then we're good. We're going to close. Right?
Oh, yeah.
That's all the underwriter does too. That's all they're doing. They're just trying to make sure the application and the numbers on there are as accurate as possible. So when if it gives us an approve eligible or it gives us an accept, then we're good, right? So that's really all we're doing. Now, when you're talking about a manual underwrite, that's when there's a little more of that, the underwriter making a little bit of discrepancy. That's going to be very few instances nowadays where that's done.
So jumping to a manual underwrite, because I've heard a lot of people call in. I've heard you guys on Dave Ramsey. I know you guys do manual underwrites, and you start talking to them. And usually either they come out and say, I know I don't have a credit score and you guys do manual underwrites. Or they say, I have a 430 credit score. I know you guys do manual underwrites. In what cases would you do a manual underwrite and how does that work?
Yeah, so that is definitely a point of confusion and kind of wish they would fix that.
Yeah.
So people call and they say, hey, you guys do manual underwrites. And I think what they hear a lot of times is, hey, you can help me even though I have a crummy credit score. That's not actually true. So the only thing we're actually manual underwriting is the credit portion.
Right.
Okay. It is possible to manual underwrite the other things, but we don't do that. And most people don't do that. I mean, this is so what it is if you do not have a credit score, we have to show that you are credit worthy. Okay, we still have that leg that's credit. We still have to show that that's
Can't just take it off the tripod.
No, it'll fall down.
Yeah.
Right. We still are responsible, so it takes a little more work, and it's not actually that much work. Now, the funny thing is, it's not just Churchill that can do this. Every other lender can do it. They just either don't know they can do it, or they're scared to do it, or they're too lazy to do it. I'm not really sure, but that's okay with me because I'm fine doing it.
Yeah.
So we do it all the time, and I think we're really great at it. I was scared of it when I first came here. I was like, oh, this is going to be a lot of work, but it's actually super easy. It's not even that big of a deal. So we do not have so a credit score shows how credit worthy you are in one neat little score. So on a normal person, not a normal person, I had to say, on a person that has a credit score,
chooses to embrace it.
on a credit score, on a credit score, if someone has a credit score, all we do is look at the score and we're like, you're good, done. On to income, on to assets. Well, I don't have a credit score. Okay, stop. Okay, it's going to be a little more work, but here's what we got to do. We got to prove that you're credit worthy. How do we do that? We got to show that if you have living expenses, you paid those on time for the past 12 months. Okay, and then on top of that, we have to show that you paid other things on time for the past 12 months. Now, the thing is, you have to be the person of liability on the account, and it also has to be paid from a bank account in which you're an account holder. Right. And if we can do that, that's good enough. It's like you have a credit score then. Okay. And then you qualify for our no score program. So that's basically a manual underwrite. It's manually doing the work to show someone is credit worthy when you don't have a credit score. Unfortunately, if you do have a credit score, we have to take that into account, and we can't fall back on doing that that way. Right. I mean, that'd be great if we could. We'd have tons of customers. But that's not the way it works.
That's just not it. Well, Darren, it was a pleasure. I mean, we're tailoring towards the end here, wrapping up. Is there anything else out there, as we wrap up here that you'd like to say to listeners, to folks that tune in, just about the process, about yourself, or anything you'd like them to know? Yeah,
just about Churchill in general. I mean, we're not like other mortgage companies. I can honestly say that, and I say that with confidence all the time. And I think people can tell when they call that we dig a little deeper. I think we care a little more. We just have the heart of a teacher. We want to do the right thing. I mean, in the end, we don't just want to have people move into homes and get into mortgages because they can, but we want to do it because it'll be a blessing, not a curse, as Dave says. And so that's what keeps me working here. That's what keeps me going every day. So I can help people and make a difference. And so I think you can tell that as you're doing a loan with us. And we have lots of reviews and lots of customers that keep coming back and back. And I think that's the reason why. So.
And Darren, are you into social media at all? Do you promote your loan business through social media whatsoever?
I'm up there in the years, so I'm a little more minimal than some of you young guys, but I dabble a little bit.
I was just giving you the opportunity. If you want to, you can always drop your handle here and put yourself out there a little bit more. But I always
don't
like
have
you.
a hashtag or.
We'll get you set up.
We'll get you working. So, but thank you guys. Thank you, Darren, for joining us.
Teacher.
Bounce.
But thank you for listening. Thank you for joining us today. All some really, really super good information. But this is Churchill in studio, and that is a wrap.